Hello everybody and welcome back to a very special edition of my investment journey. This is the first episode of 2026 and it is a special one. I will, of course, as always, do my trade. So this is the first thing I'm going to do. And afterwards, I'm going to go into a couple of things that might be interesting to you. So I'm going to talk about my approach and mindset when it comes to investing, especially for 2026. And then I'm going to talk about what to expect from 2026 and what to watch out for. But more on that later. Now, without further ado, I'm going to make my trade. And as always, I'm going to invest 1,000 euros into the MSCI emerging markets. This is about 1,170 US dollars. And yeah, let's go right ahead with the trade. I got the 1,000 euros ready. I'm going to put in here my 1,000 euros. Let's review the order. Seems all good. And buy. Order placed. Okay, let's check. And there we go. It seemed to have worked and it looks perfect. Yeah, the portfolio definitely grew a bit. I think we're up, actually 2% today alone, which is 170 euros. Fantastic. I'm not going to expect this to continue, but yeah, let's start the year strong, I would say. All right, so let's briefly look at how the markets developed over the past week. Looking at the dashboard here, what we can see is that the MSCI World didn't have the best start, but the MSCI Emerging Markets really had a great start. I think primarily the US haven't been doing so well, but most of the other markets did. But let's not overinterpret this already. I think it's important to go into 2026 with the right mindset. Now let's talk about my mindset and specifically my approach to investing and also what I'm expecting for 2026. In a future episode, I'm going to talk about some of the other things that should concern us, which is primarily the role of AI, which is one topic that we keep talking about in every episode, and also about other things such as geopolitical risks and conflicts. So let's start with my investment approach. And here you can see my asset allocation. And you can see pretty much that 90% or more than 90% of my money is invested in the US, so S&P 500 and NASDAQ. In the other developed markets, excluding the US, I have 0 invested, and in the emerging markets, I have less than 10%. So knowing that I have right now 9,000 euros invested in emerging markets, you can deduce that I have a 6-figure portfolio. But it was mostly US so far because I always followed Warren Buffett, who said, don't bet against the US. And I think that served me pretty well. It's just that I see some risks here and I want to decrease my US exposure and just diversify a little bit. So I don't touch my US investments for the moment. I am going to invest heavily into the emerging markets. And eventually, I'll also invest in developed markets excluding the US, which is Europe, Canada, Japan, and Australia primarily. And I think I should have done this a little bit earlier already. 2025 saw the US return 17%. So this is the MSCI United States, not the S&P 500, but the MSCI United States. And that's a great year, but look at the developed world, excluding the US, almost 32%, and the emerging markets more than 33%. So maybe my push for diversification came just 1 year too late. Overall, I'm not going to complain. I had some great years with the S&P 500, with the NASDAQ, but I think it's time to diversify. And it's also that people told me, hey, how can you be so exposed to the US? Don't you see the cracks in the wall? And actually I do. I mean, I see all the points why someone would not trust the US anymore. The US were just head and shoulders above everybody else over the last 15 years or so. And so I felt vindicated and I always stuck with that decision. But yeah, of course, let's look at some of the cracks in the wall. Here you can see two different surveys. The left-hand side shows inflation, so prices paid, and the right-hand side shows employment figures. And the inflation graph shows that, prices are going up. And what you want to do as a government or as a central bank there is increase interest rates. Now, this price increase was certainly also driven in the US by Donald Trump's tariff announcements. And so what you want to do is increase interest rates to cool down the market. But that wouldn't help the stock market, so that would be bad. And when you see the right-hand side graph, if employment figures are down, you want to decrease interest rates to fire up the economy. And so you see here conflicting goals, and it's not clear what the central bank should do. And that's a tricky situation. And then there's Donald Trump, who, like I said, the tax announcements were already a big market mover, but then he also introduced his big, beautiful bill. And here you can see pretty much his priorities. The top bar shows you how he wants to use the money of the bill, and the bottom bar shows you where he wants to get the money from. And so on top you see that he wants to use it here for corporate tax cuts and personal tax cuts. So those two big blocks, they are clearly what he wants to use the money on. So tax cuts is his biggest priority. And where does he want to get the money from? Well, he wants to cut student loans, and he wants to cut the safety nets such as Medicaid and SNAP, which is I think the food stamps program, and the green economy, so electric vehicle subsidies and so on. So clearly he wants to give money away to taxpayers, which is middle and upper income people, and then take it away from, poorer people. And one of the problems that I see is that there's a big disparity between rich people and poor people in the US. And I found this chart quite interesting. How much of the consumer spending is done by the top 10% of income earners? And this is almost 50%. So the top 10% of income earners make up almost 50% of consumer spending. And a generation ago, this was less than 40%. So clearly, there's a wealth concentration, and the American economy isn't working for everybody. The only question is, where else do you want to invest? For me, the biggest risk overall is debt. The US have a lot of debt, but which country doesn't? This is an interesting chart. You see here the debt as percent of GDP for different countries. And unfortunately, Japan skews the graph a little bit, but Japan is an outlier always. But all the other countries here, the major economies, they have high debt levels. The US is at 125%, and by 2030 won't be very far away from 150%. And that's extremely high. France is also high in Europe. What's surprising to me is that even China is almost at 100% of debt versus GDP. And the problem here is the interest payments. So countries have to spend a lot of money on the interest payments alone. And here you can see what percent of GDP is spent on interest payments. And that's between 1 and 5% across these major economies. And just for comparison, I put here the military expenditure, and the interest payment in a lot of countries is already higher than the military expenditure. And now it seems like debt is becoming a matter of national security. So I think this is really a powder keg, and the next recession is waiting to happen. Maybe the biggest we've ever seen. But then again, we can't predict the future. And the way I see it is anything can happen. Even in my lifetime, I've seen so many triggers, and if we say that we are in a dangerous environment, there's high debt levels across the board, then we're just basically waiting for a trigger. But in my lifetime, I've seen such crazy events already that I didn't think were possible, that I'm now convinced that we cannot predict anything. I mean, the dot-com bubble, which happened at the beginning of the century, that's kind of clear in hindsight. Okay, there was overinvestment into unprofitable companies, fine. But then the financial crisis came, and the trigger here was the real estate sector. And you would have thought that this is the most boring sector that can never go bust, but actually it happened. And so if the real estate sector can go bust, anything can happen. And then we saw the COVID pandemic. I mean, there were lots of crises in between, but then COVID was a big one. And I thought this is a thing of the past. You know, the Black Plague, the Spanish flu. But that we would have a global health emergency, if you had told me, I would have said you're crazy. And then 2 years later, we had an inflation crisis that certainly had to do with COVID, with disrupted supply chains, with a lot of debt that was incurred to support flailing businesses during COVID, and of course also the Ukraine war. Now, same story here. I wouldn't have thought that a war in Europe is possible in my lifetime. And yeah, it might have been a stupid idea. Maybe if he had known how it would turn out, Putin wouldn't have started it. Whether it's logical or not, it still happened. And we have to deal with it. And that, of course, led to an energy crisis in Europe, and it spiked energy costs, and it also contributed to the inflation crisis. And then the latest one was Trump's tariff announcement. And this is probably the craziest of them all. I mean, the announcement itself, the charts and figures that were used, all of that didn't exactly boost confidence in the administration. But you know what? This blew over too, and the market ended up. And what I'm trying to say is, yeah, there might be smaller crises, there might be bigger crises, but if you're a long-term investor, it shouldn't concern you. And so we're really not clear what's going to happen. Something's going to happen probably, but we can't say what, and it's impossible to predict. And in fact, I like this quote from JP Morgan, and they said, you know, what to expect for 2026. And they said something like, yeah, this year looks to be another version of 2025. A 10 to 15% correction at some point due to profit taking and a growth scare, but then equity markets end the year higher than where they began. You know, so, I mean, something will happen. We don't even know what's going to happen. Maybe there's a growth scare around AI, maybe there's some bad news, and for a moment everyone is a little bit unsure about everything, but then in the end, you know, we're going back to business and the markets end higher. But what are the actual stock market predictions? Here I have the predictions by some of the most important asset managers, investment banks, and so on. And it's super interesting. The market, the S&P 500, closed the year 2025 at 6,881 points. And then you see all of those predictions. And the funny thing is, they vary wildly. I mean, it's crazy. The predictions are between 7,100 and 8,100, which corresponds to, you know, the most pessimistic ones say plus 3.7%, and the most optimistic ones say plus 18.3%. And these are the best paid guys, supposedly the smartest ones, and you see that they have absolutely no consensus. They have no clue what's going to happen. It just turns out that on average, they're clustering around the 10% mark, which is the long-term historical average. Okay? But you know what? This is not the upper and the lower bound. It could easily happen that the market does better than even the best prediction here and say returns 25%. On the other hand, it might also be below the lowest prediction here. I mean, who's to say that the market won't crash? Maybe it's down 30 or 40% by the end of the year. We don't know. And also these guys don't know. And if they don't know, you don't know. And so that's why my approach at the end of the day is the following. I will keep investing steadily. I won't try and outsmart the market. I won't try and time the market. I've tried this in the past, didn't go well, cost me a lot of money. So I'm just going to stick to the basics and keep it simple. The only thing I want to do is I want to diversify more globally. And as you can see right now, I'm investing more into emerging markets, and maybe in the future, I might also invest more in developed markets outside the US, so Europe, Canada, and so on. But for the moment, we stick with the emerging markets. You can follow my journey every week. Follow me, like and subscribe, and I see you next week.